So much to cover today, and we want to get to as much as we can. But as we are going through earnings season, we're realizing that earnings are working. And what I mean by that is companies are reporting better revenues and better earnings, and they're up 18%. However, what we are seeing, Derek, is how the market reacts to that.
Yeah, and this is eerily similar to what we saw in March of 2000, where companies that beat by this wide a margin actually aren't rewarded after they report. Generally speaking, when a company beats estimates by a wide margin, you'd expect the stock to go up, but that has not been the case. There have been a few cases where they have, in the case of Netflix for one, but generally speaking, the earnings were already discounted by the sharp rally we've seen since the election.
And so when election season ends, and remember this happens every quarter, public companies have to make public their report card, that there's likely that we're going to start seeing the road get a bit bumpier and some people start to take some profits. We've had a heck of a run so far this year.
We certainly have. And the other thing we've seen, too, is the Treasury market has really gotten slammed. I mean, the 10-year was below 1% when we began the year. It's now up to 1.2%. And it's getting closer and closer to an area in which Treasuries actually start to look a little bit more attractive relative to equities than they had previously.
The reason why we talk about Treasuries a lot of times is not that we should think that people are going to run out and buy Treasuries or that we're buying Treasuries for our clients. It is an indicator of rising rates, and rising rates has an impact on all kinds of prices, from real estate to equities to fixed income. That is why it's so important, and why we start to see those rates starting to rise is numerous.
Yeah, and the big one to me is when you think about the valuation of assets, an asset that has a more long-dated stream of revenue, like a growth stock or a very high-octane growth stock. If you start to raise the discount rate by which you discount those cash flows, the valuation of that company comes down very quickly because so much of their future earnings are way out there in the future. So that's something that can alter one's perception of how their portfolio ought to look and should warrant some reallocation depending upon one's circumstance.
Another reason why rates are rising is there's so much liquidity in the market, and obviously more coming. The Democrats are looking for $1.9 trillion on top of all of the stimulus that's already been injected, Derek, and that's an enormous number.
It is. I mean, right now, the Senate has passed a bill, the Congress has passed a bill, so now they have to reconcile the two bills. Their deadline is somewhere in the middle of March, and what they have to find out is, there's some elements of that bill that probably cannot be done via budget reconciliation, which simply means needs a majority vote, and that's important because there's another bill they want to do down the road, which involves infrastructure and potentially raising taxes. But we heard some interesting tidbits this week on taxes too, Dave.
Yeah, that's right. That we may not see it this year, and that would be a big deal because so much of tax planning is done with wealth management. Should you take a capital gain? Should you defer it? Should you sell an item or should you not? We are paying very close attention to this. But when we talk about liquidity into the market, it goes somewhere. And one of the stunning numbers that we saw this week is Bank of America reported they had the largest amount of inflows into their equities ever, $58 billion, and that is just new money going into equities. On top of the liquidity, that does mean that equity prices are going to go up.
You would certainly think so. Another stat that we saw last week that I still just can't believe is that 40% of the U.S. dollars ever printed were printed in 2020.
Yeah, that's an incredible amount. With all of this being said, you look at what's happening with the dollar, with liquidity, with the amount of vaccinations that we're starting to see, and the reopening trade, there's probably a time that you need to look at your portfolio, if you're not a client of Annex Wealth Management, and say, why do I have what I have? Why do I own what I own? How much am I paying for it? Does it make sense going forward? All of these are great questions, and there's a way to get that done.
Dave, how many do-it-yourselfers have you run into over the years? I would think
lots.
Hundreds,
of them.
Right? Yeah. And we've got really smart people that are in this audience that are listening and have done their stuff, and you've gotten so close to the finish line. There has to be a point where somebody says, you know what, I need a pro to get me over that line.
And that really happens. And a lot of times people come in, Danny, and they say, can you help us? Or if something happens to me, what about my spouse?
And I'll tell you this, many times I bet we say, you've done a great job.
That's right.
But we want to get you over. We want you to think about, tax planning and estate planning. All those things. You've been saving and investing and doing a pretty good job. Get you over the finish line. Focus you for 2021 and beyond. One less thing to be thinking about.